at the Solomon Trading Institute. Today is December the 9th, 2022, and I want to do a quick market recap. Hey, listen, if you want to learn more information about what we do, go to www.moneymarketedge.com and you can learn all about what we do. The Solomon Trading Institute is what we have put in place so that we can help you get to where you want to get to. You can book a call and talk to us if you want to know more information. If you want to invite me to churches, I do Word and Wealth conferences all over the country. And if you want to invite me to do one at your church, your club, your fraternity, sorority, I'd love to do that. Your school, even, I'd love to do that, to come share money market literacy. See, most people know financial literacy, right? But there's a difference between financial literacy and money market literacy. 52% of all Americans have money in the money market, but they don't know how to work it. So they trust someone else to work it, some portfolio manager, some pension fund, some retirement fund, things of that nature, and some CDs, things of that nature. But however, if you want to learn how to operate in the money markets yourself, that's what we do. We call it DIY, do it yourself. So you can learn how to do just that. This book is what I wrote, The Money Market Autopsy. You can go to Amazon.com and you can put in Money Market Autopsy and you can see exactly what's going on here. Okay? And that'll give you some information and some insight on what we do. Now, today's market recap. Before we get started, I want you to notice something. Today is Friday, December the 9th. One of the reasons that we are so consistent is because we don't put ourselves in situations that would be harmful to us in terms of trading. So out of 240 trading days, we look to get trades 200 days. What does that mean? That means that there are 40 days that we don't trade. But in those 200 days, there are some days that we do trade, but we have to be very, very careful. Careful because sometimes there is some fundamental news that can actually impact the market. So on today, if you notice at 7:30, there was an announcement here, there was an announcement here. So what does that do? Well, that creates what we call fundamental shifts in the market. So that means that you have to be aware and you have to make sure that you know exactly what the market is doing as it rebalances itself. So as you can see, there are many people who try to trade and they lose money because all they're focused on is a counter pattern, or all they're focusing on is a trend line, or all they're focusing on is a level where the market should turn around. But that doesn't drive market activity. Your trend lines don't drive market activity. The levels that you say the market should come to does not drive market activity. Moving averages don't drive market activity. Indicators don't drive market activity. What drives market activity is volume. And so that's what we have put together. And we'll talk more about that. But now this fundamental aspect of the market is definitely critical for you to understand. So today, the University of Michigan, the Consumer Sentiment Index, and what does it do? It rates the relative level of current and future economic conditions. There's a survey that they do with 500 consumers now, and they give a report. And when they give that report is going to come in below this actual number or above this actual number. So the forecast of that report was below this number, and it actually was below this number previously. So whatever happens at this point is going to drive market prices. Well, if all you're doing is opening up your charts, drawing your trend line, finding your levels, looking for your counter patterns, your reversal patterns, your head and shoulders patterns, your, all of those things that, you're taught to do, and you don't understand what's behind market, the underlying driving forces of the market, well, that is the reason you can't be consistent, and that is the reason you can't make money. So here at the Solomon Trading Institute, we teach you about all of this. So this actually affected the market on today. So what does that mean? Now, check this out. Because of this fundamental impact news, right? University of Michigan Consumer Sentiment. Now, they have two. This is the preliminary report that came out. And so it came out at 9 o'clock. That is the time of the reading. So because that came out at 9 o'clock, look what happened down here with that information. So at 9 o'clock, you can see that we have four different 9 o'clocks. Well, what does that mean? That means within the 60 seconds of that information coming out from 9 o'clock to 9:01, within 60 seconds, we have all of this activity. Now, if you don't know that this consumer report is coming and you enter into positions here, well, that's financial suicide. So now what do? Because of this announcement, what we want to do is, as smart traders, we want to allow the market to balance itself out. So from 9 o'clock to 9:25, 25 minutes, we don't even take trades. See, it's not about trading. The goal of trading is not to perform the act of trading. Let me say that again. The goal of trading is not necessarily to perform the act of trading. The goal of trading is to make money. So, in order to make money, what you have to do is you have to minimize and mitigate the risk factors. Okay, so you may or may not know this. If you're a trader, you need to know this. Whenever you're looking at a chart, there are two risks on the chart at certain times. And you can wait until that time period is over to eliminate one of those risks. So, first of all, there's information risk. What does that mean? There are some things about the market and its historical movements that I do not know yet. So if I don't understand information risk, I then would enter into the market after an announcement like this and hope that everything works out well. Well, because of this announcement, we need to see what is the reaction to this market. So then there's another risk that you cannot get rid of, which is called price risk. Okay, so since I must have price risk, that means I can get rid of information risk. So why don't I wait from this time to this time so that I can eliminate the information risk, and then I can begin to take my trades after I have the information? Well, what information did I get from here? Well, that is the reason you have to join the Solomon Trading Institute, so that you can get that information that I'm talking about. But the bottom line is that I want you to understand that there's a period of information. Now, typically, I use the period, an earlier period, to wait for information and get started at 9 o'clock. But today, because the 9 o'clock start is where I typically start, well, I had to wait now all the way to 9:30. And as you can see there, that is when the first trade was taken, around 9:28, and between 9:28 and 9:30. So let's look at the trades. First of all, I need you to make sure that you understand that if you are able to get 200 days in, and you can make, just with one contract, let's say you started off with just $5,000. Now, first of all, I need to make sure you understand this. I am not licensed. I'm not a licensed broker, nor am I a registered agent with any United States brokerage firm or any United States regulatory. I am a retail day trader and I am an educator. And because of that, I have to make sure I tell you this disclaimer, that there are no promises, there are no guarantees. Past performance does not mean that you will get future results. Because you see what I'm doing does not mean you can get future results. Now, that has to be said because it's important that there's not a run to the bottom, because there will be people who will be unscrupulous and try to get you into situations just to get your money. But what I'm doing is I'm telling you, what we do is we define, determine, and we reduce risk by providing a world-class education on technical analysis, as well as top software that will help you as an analytical tool. And then we reveal the strategies that create for you an edge. So there is a risk, but you can know the risk. You can understand the risk. You can mitigate the risk. You can prepare for the risk. You can train for the risk, and then you can know the reward. Okay. Now, so let's say you make $400 per day, just with this $400 per day, and then you do this every single day. Well, that $400 makes you $8,000. That's one of the reasons I do the market recap, and I use one contract to show you that it's possible to do this in a day. All right. So here's today's activity. So today I was able to make $555 with that one contract. Now check this out. Here is trade number one. Here's trade number two. Here is trade number three. Here's trade number 4. Okay, trade number 5 was able to make 140 bucks on that one trade. Trade number 6 was able to make over 100 on that trade. Trade number 7 was a little small guy. Here, 30 bucks. Trade number 8. So notice, all of these trades are not the same size. Okay, so now the first trade, $55 was made. That's trade 1. Trade 2, $55 was made. That's trade 2. Trade 3, $55 was made. Trade 3. Trade 4, $55 was made here. Trade 5, we're able to step on the gas, $145, which is here. Trade 6, $105 here. Trade number 7, 30 bucks here. And then trade number 8, 55 bucks here. Okay. So the question is why are not all the trades the same? Why was not the target the same? That is what, unfortunately, when you don't know how markets work, you define targets based on a book, based on YouTube, based on what you want to make. But targets should not be defined based on anything other than what the market conditions are allowing. Now, market conditions determine both defined targets and defined stop losses or exits. Market conditions. Now, there are some people who scalp all the time, and that's fine if that's what you do. But you don't have to relegate yourself to that. You can learn. We would teach you how to look at the market, how to read the market, and how to understand what's going on. You cannot be successful at trading if you have static targets. Well, I go for 30 ticks every day. I go for 20 ticks every day. And I put my stop loss here and I put my targets here. That is not how trading works because the conditions are always changing. The value is always developing. There's always changes in the market. Think about this. When you go to the store, bread can be one price today and another price tomorrow. When you go to the gas station, the gas price could be one thing when you turn into the station, but by the time you get to the pump, the price has already changed. Why? Because that is the real way markets work. So many people who try to trade, they try to make the trading, they try to make markets like a video game, like this is the way it works. No, it's dynamic. It changes. It has ebbs. It has flows. It moves. It volatility picks up. Volatility slows down. Volume picks up and volume slows down. So if you don't know how to read that, that's what we do. That is the reason we're successful is because we teach you how to understand how the markets work. So we took the target here, 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 here. Notice a different target and a different target, right? So 3 different types of targets. Does that make sense? Okay, so now you can understand this. Now, I took some more trades after this, and I called it, afternoon tack on, and I'll show you that. But now watch this. So with this tool that processes images, recognizes patterns and networks, with other technology, you would discover that indeed it is possible to know when the market condition is favorable. So when you're looking at just regular candle charts and you're not understanding volume, you're not understanding what's going on, the cumulative delta, you're not understanding those things, all that stuff is embedded within what we do. So if you don't know all of those things and you don't know developing conditions, you don't know changing conditions, you don't know what's going on, you're just looking for a candle pattern or you're looking for a trend line, well, stop doing that because you need to know when the market condition is actually favorable. Then you need to know exactly when to buy. I think it's going up, I think it's going down. No, you need to know with almost a 99% probability that that market at that particular time is going to do what you want it to do. So you can know that. This is not a secret. You can know that, right? Then how long do I wait for targets to be filled? Sometimes I wait 8 seconds. Sometimes I wait 3 seconds. Sometimes I wait 10 seconds. What is the difference? Understanding and knowing when to wait, knowing when to hold them, knowing when to fold them. And then there are times, today was not one of those days I was 100% today, but yesterday I was just 84%. And if you go back and look at all of the market recaps, there are many days that I'm not 100%. Why? Because I understand that it's more important to make money than to be right. It's more important to stay solvent than it is to hold on to a bad idea. Capital preservation must be your priority. Guess what? If you don't have any money, you can't trade. So listen, why would I allow the market to take my money? If I'm wrong in a trade, I get out quickly. And in my book, I write that in my book there's a section called the 20 Habits of Wealthy Traders. And habit number one, if you get my book, go to Amazon.com and pick it up. Habit number one is wealthy traders are patient with winners, but extremely impatient with losing trades. If a trade is losing, let it go, period. And we'll talk about that in our training. So how long will the market, how long will market will go up, or how long will it go down? That is the reason there were some trades that were gotten out at this amount. Other trades were gotten out at this amount, or exited, shall I say. Hopefully my English teacher's not listening. Okay, and then some trades were exited at this. 3 different exits. Why? Because there were 3 different conditions. Man, I cannot wait to help you, change your life and understand. There's so much money in markets. If you understood them, it would be just an amazing thing. So here's the proof chart. So I'm not just throwing out a bunch of numbers. Pardon me. I'm not throwing out a bunch of numbers. Here's trade number one. It was entered here. Remember, I talked about that information period back in here from 9 o'clock to 9:25 because of that fundamental news. Well, here's where I waited because I was able to look back there and get the information that I needed to let me know that I can enter here and exit there. That's trade one. All right. I missed this trade. That's why that's dark. And I missed this trade as well. So, but that's okay. When you miss a trade, you miss it. There's always another one. You never chase the market. You wait for it to come back to you. Now, here's trade number two, in and out of there. Why am I getting out? Because that's where the target was. That's where the target was. Here, in there, that's where the target was. So knowing when to get out, how long to hold them, the target did, the conditions of the market said, I can't hold past this, not with high probability, okay? Right here, I have another target in the way. So this is a target. This is where the market was targeted. I put these lines on here. I put that line on there, and we will tell you and show you and teach you when to put lines, where to put targets, okay? Then trade number three, we have an impulse leg here. So I had to wait for all confirmations from all of my other charts. And once I got the confirmation, I entered here. Well, why did I get out? The target is right there. That's a dynamic HVA target. That stands for high volume area. So this is an area. Look how it became choppy because it's a high volume area. You have to know that that line is there. You see? All right. Boom. Trade number three. All right. Trade number four. Here, I entered into this trade. The conditions had changed again. So we had a condition change here, and then we had a condition to change here. So I entered into this trade. Now this is the scenario that I was talking about. When do you know to hold? Because once I entered into this trade, I had to hold through this retracement, and I didn't get out of this one. Why? Because the target was up here. So I knew that this was what we call absorption. It was not a reversal, it was a retracement. How much better would your trading be if you could differentiate almost at a 90% clip what the difference is between a retracement and a reversal? Oh man. So so when you think a retracement is a reversal, you get out on the way down with a loss and watch the market go up with your money. And you say to yourself, I knew it was going up. But guess what? Because you don't know how to read volume, volatility, you don't understand cumulative delta, you don't understand these things, right? You're really just giving your money away if you have not been taught how to trade, right? Not exposed to trading, but taught how to trade. Okay, so I was able to stay here because of the target, and then you can see these little white dots. Big volume came into the market here. So I know that the institutional traders are not going to lose their money. So if they put big block orders in right here, this had to have been a retracement. Re- Let it go, and then bam, got back out here. You see that? All right, boom, bam. Now, trade number 5, entered in again. Here's what I'm talking about. Entered in again. That retracement, actually, that's the trade I just got to explain it. Entered here, took this retracement, boom, 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 bam. Why? Because the target was in sight, a dynamic high volume area. Oh man, what if you knew that stuff? All right. And so then trade number 6, in here, out there. You see my tool? I knew that from this part, this point to this point, I had 43 ticks worth room. So that's the reason you can't just have, hey, my target is this, my stop loss is this. What do? I do a 30 tick target and a 10 tick stop loss. I do a 15 tick stop loss and a 30. I do a 10. No, no, no. That's static. How can you put a static requirement on a dynamic environment? You can't do that. So listen, we love to teach you and show you all of the things that we know. Here's the afternoon session where I tacked on. And so I was able to move that 470 number all the way up to 555. So here's where I entered into the market here, and here's where I got out. Guess what? I I walked the chart. I walked it up, made money here. Guess what I did here? I went short. I went short here and made money there. Right there in a matter of 10 minutes, I made money long, then I made money short. How? Because I knew that the conditions had changed. That is the holy grail of trading, understanding and knowing when conditions change. Now, I want to make sure that you understand what we have to offer. We're going to teach you how the market really works. The only way to experience consistency, that's the reason I show you the proof chart and not just a bunch of numbers. People will show you a bunch of numbers. Look at what I did over this period of time. Well, where is the chart? Show me where the trade was taken. Show me where it was exited. Prove it to me. That's what I just did for you. The only way to experience consistency in the market is to surrender to our rules-based approach while understanding the why behind the charts. So there are the charts, and most people focus on the charts, but they don't know the why behind the charts. So learning the rules isn't an option because the rules connect you to the why. You must learn them. There are no shortcuts to consistency. So when people tell you you're going to make $1 million tomorrow, no, you're going to go to school. It's going to take you 30 days, right? At least to understand what's going on. Then another 30 days to practice. And then now you're ready to go. Well, guess what? You went to undergrad for 4 years, maybe even got a master's and don't have a job in your field. So what's so hard about taking the time out, doing your schedule so that you can take 3, 4, 5 weeks to put yourself in a position where then you can begin to practice to do something that would absolutely change your whole entire life. We have Q&A. You must participate in that daily. So we have classes roughly 225 to 30 days per year. Every year, we have instructors in the orientation class, the freshman class, the junior class, the senior class, right? It'll take you roughly 8 weeks to go through that undergrad curriculum. And then you come to me for continuing education. So you must participate in that, man. We can't wait to have an opportunity to help you. So how do markets really work? You got to meet the players. You have to know who is in the game. There is unintelligent money or dumb money or what I call shark meat. The retail day trader, most of them are shark meat. They don't understand. They are speculative and uninformed market participants. How do you measure volume in the market? How do you measure volatility in the market? How do you find out if there's divergence in the market? You know, where the price is going one way, but the underlying sentiment is going the other way. Not if you're just looking at a candle pattern and a reversal pattern and looking for a trend line. You don't know that stuff. It the dumb money, they don't even believe that smart money exists. They think it's a fair game. No, no, no. In my book, in the beginning of my book, I talk about that, hey, listen, there are many manipulative situations out there, right? And it appears to be manipulative, but you just don't know the market. You have to learn it. It's not taught in school. All right. So you have to, they don't even believe, the dumb money don't even believe, doesn't even believe that that smart money exists, that there are two groups of people, the people who are the prey and the people who are the hunters, right? Dumb money believe that indicators can predict price movement. Indicators, this is a false perspective. So you're looking for the next indicator. Oh, I need to move this moving average. No, I need to change to this moving average. No, I know what I need to do. I need to get the MACD. Oh, no, no, I know what I need to do. No, 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 no. Those things do not drive price. Knowing and unknowingly, willingly or unwillingly, they serve as free money for the informed. You know, every time I win a trade, I understand that somebody just lost that money. So here's the intelligent money, the sharks. They understand that they provide liquidity in the market. They understand that they put the money in the market because they're brand new dumb money that enters the market every single day. I'm about to trade. I'm ready to make some money. Dumb money is handled sometimes even by smart people, investment banks, large public funds, private funds. Funds disappear daily, even in those. That is the reason I say learn how to do it yourself. Because you have money sitting somewhere, you don't know what's going to happen. You don't know if the person managing it is dumb money or smart money. You have no way of knowing. You never met them. Smart money holds the perspective that because they know exactly what the uninformed believes about markets, that they have a massive advantage. And I see it every day, a massive advantage, because I know what the smart money is thinking. Although they provide liquidity, it is done at an exchange premium, meaning they oftentimes, listen at this carefully, the institutional traders oftentimes make trades against the current market sentiment. Wow. They know the market is going up, but they put money in the market to go down to attract the retail trader to make them think that the market is going down. And they later go back at some point and mitigate that loss. That's why you see the market going up and going down and going up and going down. Sometimes they go down to get the money back that they put in down earlier, 30 minutes earlier. They go back 30 minutes later, get everybody to go in and stop them out. Why? Because they put money going down, so they're going to create people to go down and then stop them out to mitigate that loss and get that money back. Smart money, they believe that everyone else's money belongs to them and that eventually they're going to simply give it to them in the form of buy stops, sell stops, pinning, and resting orders above and below highs and lows that are recently developed. They understand that they set price. Indicators don't set price. How the market really works, I'm wrapping this up. You're going to have to adopt the smart money perspective. That's what we're able to teach you. Markets trade in a very structured and efficient manner that is slanted in such a way that it laces the pockets of the smart money. So you too must know the perspective of the uninformed. You too must know how the uninformed are manipulated by smart money. You too must know how price is delivered through the following principles: expansion, retracements, reversals, and consolidation. Hey, listen, how the market really works. Intelligent activity alerts. When is volume increasing and decreasing? When are spreads widening and narrowing? When does institutional order flow kick in? Our software allows us to know when and where the extremes in the markets are prominent. Hey, listen, Again, I'm Cornelius Wilson Brown III, Solomon Trading Institute, Money Market Edge. Text the word profits to 94253 for more information. Check us out on our YouTube channel, Edge TV. MoneyMarketEdge.com. Book a call. I love to talk with you. I can help. God bless. Have a wonderful day.